Now we're talking about common stock valuation here. And in the previous video I told you that John Burr Williams invented this model called and a theory called the dividends theory. And he and Myron Gordon did lots of work in dividends theory. And the basic stock valuation model that we're going to learn in this course at any rate says that the intrinsic value of a share of stock is equal to D1 over K minus G. Now the numerator D1, that's the dividend you expect in the next time period, not the current dividend. The current dividend is D0. To get D1 to forecast your next dividend, you take the current dividend and multiply it by 1 plus the growth rate, which we're going to talk about a bit in this video. K is your required return. Required return is your minimum acceptable return on investment. You want to be compensated for the risk you take on investments. The way we calculate required return, we use the capital asset pricing model. And in the next video now, we're going to talk about how we do that and what this is and how it makes sense, I guess. G is the constant growth rate. Now, that's what G is. And as I told you before, if we put 5% in this equation, 0.05 here as G, that assumes that both the dividends and the earnings grow at 5% per year. Now, dividends and earnings growing is important because remember that dividends are paid out of earnings. So dividends can't grow faster than earnings. If they did, then dividends would overrun earnings. You wouldn't have any earnings left. You'd have, dividends would be greater than earnings, and that can't happen. So when we say a constant growth rate, we're talking again about a growth rate in both the dividends and the earnings of the company. Now, how do we calculate growth? Again, if you study and become a chartered financial analyst, in the common body of knowledge now, they're going to teach you to calculate what's called the internal growth rate. And the internal growth rate is the company's return on equity, ROE, multiplied by 1 minus the dividend payout ratio, DP, the dividend payout ratio. Now the dividend payout ratio is simply the dividends per share that a company pays divided by the earnings per share. If your company that you had common stock in earned $10 a share, that means that if you multiply that by the number of common stock shares that you own, that's how much of the earnings belong to you. So on a per share basis, you own $10 for every share that you own. If the company's paying $3 a share in dividends, well, there's only two things you can do with earnings, right? Paid out dividends or retain it in the firm. That means they're paying 30%, 3 over 10 in dividends. So that's your dividend payout ratio. The dividends per share divided by the earnings per share. 3 over 10 is 30%. The other 70% is what they're retaining in the firm. 1 minus the dividend payout ratio is what's called the retention ratio. And that's what's in that bracket right there, 1 minus the dividend payout ratio. Multiplied by return on equity. Return on equity now is a measure of the company's earnings, we'll use net income here, divided by the equity of the company. That's ROE. If a company paid out all of its earnings in dividends, they earned $10 in dividend and $10 per share, and they paid dividends of $10 a share. That means that dividends and divided by earnings per share would be 1, and 1 minus 1 would be 0. 0 times anything is going to be 0. So if a company pays out all of its earnings in dividends, its internal growth rate is going to be 0. That's not really what most people want, but that's what that implies, and that's what that's telling us. Now, other ways to calculate growth. You could collect all the dividends per share over the years. What's the implied growth rate in dividends per share over time? Or you can calculate the growth as a function of earnings per share. What's the earnings per share for this company been over the last 10 years, every year? And what's the implied growth rate in earnings per share? All of these kinds of things now are giving you a way of looking at the growth of a company and At some point, you have to come up with a decision as to what you think is the appropriate growth rate. But again, G is an important thing. Growth is an important thing in driving the value of a company, and you have to come up with your estimate of growth. And this is the model now that we're going to talk about when we talk about finding the intrinsic value of a share of common stock. This is the dividends theory. In the next video now, we're going to talk about required return. We're going to talk about the capital asset pricing model.